we're really big fans of what we're seeing right now in sort of the revenue generating lower middle market of private equity.
Great to see you again.
Nice to see you. Good to be back.
Yeah, thank you.
We are a multifamily office that is benefiting from the very dynamic that Jonathan just mentioned, which is there are many boomers retiring, selling their businesses. And so we specialize in tax planning, exit planning, and then alternative investing when it comes time to redeploy that capital that they spent so many years building and growing. So we are a multifamily office, and we have a number of strategies that our families find compelling that we can dive into at the appropriate time. But always great to be here in this crowd.
Great. Where do you see, from an alternative asset standpoint, basic allocation growing in family offices? Obviously, like, what is that in your experience? What's that look like?
Yeah, I mean, at the highest level, there's definitely a shift away from exclusively, investing in public markets. There's more and more alts, right? And when it comes to alts and alternative investing, we're really big fans of what we're seeing right now in sort of the revenue generating lower middle market of private equity. So that can be loosely defined by a lot of different people. It might be companies between 5 to 50 million of EBITDA. And what's so attractive about those properties, not those properties, but those companies, is their valuations, right? So you look at the public market valuations, which are, depending on NASDAQ or what subset of tech companies you're looking at, 30, 40 times earnings. Well, companies in these lower middle market segments are transacting at 5 to 7 times EBITDA many times. And so you can buy a strong 20-year track record company that's kicking off 15 to 20% of cash flow, and oh, by the way, has a growth component because that baby boomer got really, you got tired of growing 10 years ago, right? He's sitting on that 4 million, 5 million EBITDA, and he's like, I don't need to open a new market up. So investing in companies that are coming in, then taking those companies, getting a leg of growth, getting good cash flow along the way, or funding growth with cash flow is really compelling to us. So we built a strategy around that.
That's great. How do you source your deals? I mean, that's a very large market, right?
It is. We're focused on partnerships. So we're partnering with specialists. We know our lane. Our lane is to deploy capital, preserve capital for our clients. So we're going to partner with specialists who that's all that they do. So as an example, and so our goal is to get diversification in that space, right? We don't want to just pick a company or a strategy. We want multiple strategies and multiple companies. So, 2 examples of holdings that we have. We have like a defense industry buyout group that we partnered with. That group has a 30-year track record of delivering 42% net IRRs. Wow. and 2.9 MOICs, right? So like, if we're partnering with them and all they've done is defense, that's where we want to be. And then we have a cybersecurity specialist. That's all they do is cyber. We have an AI specialist. That's all they focused on is tech. So, if someone puts $1, our minimum's $1 million for that specific strategy. If they put $1 million with us, they're going to get access to a portfolio that would have otherwise cost them $50 million of their own money to leg into, right? So it's an access vehicle, and that's how we look at it.